All right, so we just kind of laid it all out. Middle East tensions, port strike, we've got the jobs report coming up, a lot of things that could be volatile to the markets that investors should certainly consider. But should they make moves? Is there anything that you think investors should do right now?
You know, in terms of right now on the port strike stuff, no, probably not. In terms of Middle East stuff, it's probably a little bit too early to tell. I mean, look, we've been head faked on Middle East things several times over the last few years, and you know the market tends to look through it fairly well. This one does seem to be a little bit more serious, so we have to watch it pretty carefully. But right now, we're still optimistic that we can find a path through it.
So very quickly, if we're watching this a little bit more carefully, I'm looking at the moves in defense stocks. Lockheed Martin, Raytheon, L3 Harris Technologies, all of them up 4% week to date. Big spikes yesterday if you look at the chart. Is this a time to invest in these defense stocks with the idea that, you know, I know you mentioned the head fake, that we've seen something similar to this in April. We're going to talk about that later in the show. But either way, it just seems like there's going to be more money going in defense. We have about 40,000 U.S. troops in the Middle East. Is now the time to perhaps put money in defense stocks?
Look, it's not a bad idea. I mean, we have an election coming up in a month, and neither one of these two candidates is going to spend less money on defense, quite frankly. So, and the world is not getting safer, probably. I mean, especially when we have, potential threats with China, China and Taiwan. We don't think anything's imminent there by any stretch of the imagination, but you always have to be careful. And so, yeah, those defense stocks probably are not a bad place to be right now.
All right, let's talk about something else. The Fed. We heard from Jay Powell earlier this week. Yep. What did you make of those comments? He guided for 50 basis points of cuts throughout the end of the year. So hypothetically, that could be 25 and 25 in the last two meetings. A lot of people were thinking we might get 50 in that November meeting.
I think he wants 25 and 25 because if we actually get 25 and 25, that means the labor market is cooling but not cool. And that's sort of like everything's on plan. The only way you probably get 50 in the next meeting is if the labor market significantly deteriorates. And we got a hint on that on Friday, obviously. So we're hoping for 25 as well because we do think this is a labor market that will continue to cool but not get cold. And so if we do get that, that's definitely a tailwind for risk assets.
But isn't there a difference between the labor market and the stock market? For example, I know you're really you're kind of bullish right now on biotech right now. Wouldn't a 50 basis point cut help that sector? I mean, if you look at that sector, even since the cut that we got, that 50 basis point cut, I'm looking at the IBB, I'm looking at the XBI. Both of them are down more than 2%. For a sector that you're interested in, wouldn't another 50 basis point cut, wouldn't that be great?
So in isolation, sure. But it matters why we get the 50 basis point cut. We get a 50 basis point cut because things are really slowing down. Those are sectors, especially on the biotech side, that can be a little bit levered into the economy. The reason why we like biotech and healthcare has more to do with AI than really the economy. But it matters why we get the 50. And if we get the 50 because the labor market is getting too slow and getting too weak, that's probably a problem.
All right. So overall, if we do get that 25 basis point cut, what sectors do you expect to do well? Is it cyclicals? We also saw defensives surge for some reason into the cut as well. What area are you looking at for opportunities if it goes as it looks like you expect, 25 basis points?
So I think we can start looking at small caps again. We can start looking at broader sectors. We can start looking at value again. And specifically, I'm talking about things like home builders, financials start to be a little bit interesting at that point. But anything that's more tied to a cyclical upturn in economic growth, not only in the United States, but possibly also in China, as we're seeing right now, those are the places where we think you want to be.
So if we get a soft jobs report, does that make you less bullish on the small caps? Because that's, again, a sign that the economy is slowing down.
It does. It does in the short term because it plays out the story that growth is getting a little bit too slow for comfort.